I think Bob Pisani made a good point. I think the fundamentals have to catch up, or the earnings have to catch up with the price that we saw last year, particularly in the fourth quarter. So we are in print on our 2020 outlook, 3,250 to 3,300 on the S&P. We're basically there now. I suspect what you're going to see, hopefully by June, get some clarity on phase two, at which point we'll be able to raise our earnings estimates. For right now, we're going to maintain a market weight on stocks.
So, Kevin, let me ask you the same question. And do you expect that much of the gain might take place before we get into the heavy political season, summer and fall?
So first, this year we believe that we're going to see the S&P up 6 to 8%. So if you have to put a target on it, a specific target, I would say 3450 is our target. I do believe that we're going to get most of the gains early on in the year. And as we all know, if history repeats itself, if we get strong gains prior to the election, then you would think that the incumbent would stay in office. And so I think that the president is going to do everything he possibly can to keep the market going as far as signing a trade deal and trying to push phase two along as quickly as possible to help the S&P.
All right, there's nothing like launching into 2020 with a sunny outlook. Let me ask you about a couple potential storm clouds on the horizon. One, there's a note today that the Conference Board CEO confidence survey mentioned recession is the top concern. Now, these were in interviews that were conducted in September and October before there was a timeline on the table for this phase one trade deal. But then on top of that, we have a note today about the continuing liquidity concerns. John, does that mar at all your anticipation for a smooth road ahead?
Well, I think when they took that survey, not only did we get clarity on phase one, but we also had clarity on the Federal Reserve. We got clarity about the ECB. So there's some monetary policy tailwinds, I think, and then China overnight. So when you factor all that in, I would think any CEO in year 11 of an economic cycle would be worried about recession. That's their job. But I do believe that when we look at these fundamentals, if you look at GDP of slightly less than 2%, inflation driven by wages, not at a threatening level. Producer prices are declining faster than consumer prices are rising. We think that's a good lead indicator. The only threat, I think, would be a supply shock if phase two doesn't work out. And then you could have a temporary inflation fear that could cause the market to back up before the election.
So, Kevin, one of the things that was a little bit odd about 2019 was that practically every asset class that I can think of, with the rare exception, whether it was international stocks, whether it was bonds or whatever, you made money. It was just a question of how much money you made. As you look ahead to 2019, are there asset classes that you think are particularly vulnerable and might not make money?
Well, I mean, for starters, fixed income. I think in 2020, what we're going to see in fixed income is that you're just going to get the income. You're not going to get the appreciation that you saw fixed income have in 2019. Well, a lot of those returns were brought forward. And so we expect, yields on the 10-year to be in that 2 to 2.25 range. And we feel that it's going to probably be anchored there because of the U.S. having a relative yield advantage, and the Fed being on hold has brought hedging costs down for international borrowers. And so we think that, that's going to keep it in a range bound.